Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Wednesday the 7th of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, Japanese shares rebounded Tuesday after plunging on Monday in a rout that sent shockwaves through global financial markets. The Nikkei 225 rose by 10.2% after slumping by over 12% the previous day. The percentage rise was the biggest since October 2008 in the middle of the global financial crisis. And the points gain on the Nikkei 225 of 3,217 was the biggest on record. The Reserve Bank of Australia held interest rates at 4.35% for the sixth straight meeting Tuesday and said that monetary policy needs to remain restricted despite recent global market volatility. The RBA's board warned that inflation remains too high and is coming down slower than anticipated, and that it needed to remain vigilant, and it said it's not ruling anything in or anything out. Japanese real wages have risen for the first time in 27 months. Average cash earnings in Japan jumped 4.5% year-on-year in June, accelerating from 2% in May and coming in way above market expectations, giving a boost to the Bank of Japan's plans to tighten its monetary policy. And the country's nominal wage growth outpaced the 2.6% core consumer inflation rate in June, leading to the first rise in inflation-adjusted real wages in 27 months. That 1.1% rise in real wages comes after the country's largest employers offered trade unions their biggest pay increase in more than 3 decades. Kamala Harris has picked Tim Walsh as her running mate for the presidential election. The Minnesota governor and former high school teacher will become vice president if Miss Harris beats Donald Trump in November. Miss Harris and Mr. Walsh appeared together at a rally in Philadelphia overnight, the first of 5 rallies planned in battleground states this week. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Gary Young, Senior Economist for Asia Pacific Thematic Research at Natixis. And with a view from Japan is John Beirne, who's the Principal Economist at the Asian Development Bank. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. That's where you'll also find my daily newsletter. Wall Street stocks rebounded on Tuesday as markets stabilised from the previous day's global sell-off following a sharp reversal for Japanese equities. The S&P 500 climbed 1% to 5,240 after losing 3% on Monday in the worst session since September 2022. The benchmark index was up 2.4% at the high of the day. All 11 S&P 500 sectors were positive for the day. The Dow also relinquished some of its gains of almost 750 points at the day's high to close 294 points firmer, that's 0.8%, at 38,998. The Nasdaq Composite was up 1% at 16,367, reclaiming some of Monday's 3.4% losses. Treasury yields bounced back on Tuesday as Monday's global market sell-off partially reversed. The yield on the benchmark 10-year Treasury note traded 12 basis points higher at 3.89%, and the yield on the 2-year Treasury note advanced 13 basis points to 3.99%. The dollar made gains for the first time in 3 sessions. The US dollar index edged up 0.33% Tuesday after losing about 1.4% in the previous 2 sessions. The yen was the G10 underperformer against the dollar Monday, but that does come after significant yen strength in recent days. The yen's trading this morning around 145 to the dollar versus 141.7 to the dollar at its strongest point on Monday. And the offshore Chinese yuan is hovering around 7.14 renminbi to the dollar. Spot gold ended the day 0.8% lower at 2,390. Brent crude oil settled 0.2% higher at $76.48 a barrel. Bitcoin is up 4.5%, currently trading at $56,400. Chinese markets were far less volatile and outperformed in Monday's sell-off while they underperformed during Tuesday's rebound. The mainland CSI 300 index was flat on the day. In Hong Kong, shares fell for a fourth day. The Hang Seng gave up early gains and slid 51 points, or 1/3%, to a three-month low of 16,647. And futures markets this morning pointing to a gain of about 0.2% for the Hang Seng. That's about 30 points lower. But look at this. The volatility in Japan is not over. Futures markets there pointing to a decline of over 1,100 points. That's about 3.3% at the open. So reversing some of Tuesday's gains, which partially reversed some of Monday's losses. And on we go. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Well, a lot to go through and to try and explain this morning as well in the financial markets. So we have with us two experts, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, our regular Wednesday commentator. Morning, Enzio.
Good morning, Peter.
And also with us is Gary Ung, who is Senior Economist for Asia-Pacific Thematic Research at Natixis. Morning to you, Gary.
Good morning. Hi, everyone.
Now, as you heard there, Japanese shares did rebound Tuesday after plunging on Monday. The Nikkei 225 rose over 10% after slumping 12% the previous day. The percentage rise was the biggest since October 2008. That's when the global financial crisis occurred. The broader Topics index rose 9.3%. By Monday's close, the Topics had lost all of its gains for the year after hitting an all-time high on just July the 11th. And the volatility was so intense that circuit breakers kicked in. Nikkei 225 and Topics futures were suspended from trading for a while. Equities were helped by the yen stabilising at about 145 yen per dollar after rising 10% in recent weeks. Enzio, let me kick off with you. I mean, this is not how normal, rational, developed financial markets are supposed to behave, is it? 14% decline in one day, 12% decline, 10% rebound the following day. This is not rational, is it?
No, but markets never were. I think I would call these algorithmic lemmings. What, in my mind, has happened, just to put this into perspective, is that overall, some major bank must have, in order to bolster its own profits, to keep the divisions going and to get the bonuses, of course, decided some days ago to take a major short position. That then was fed into the street and all the lemmings followed. Because, say, with Japan, a lot of this stuff has been going on for some time. I mean, why would a 25 basis point hike, it's going very American now, make the market crash? It doesn't make any sense. Why would the yen had been strengthening from a low of 150 as of mid-July for about 3 weeks? So why this? The thing that I can't answer is why this sudden lemming reaction Friday, Monday, and then Tuesday, bingo. Hey guys, it's gone a little bit over short, so over long, let's go put the short position back on, kind of thing. So it's all just very much an algorithmic lemming-like paroxysm for me.
So this is basically, you're saying, the yen carry trade that's causing this, because that's where a lot of the program trades occur.
Yeah, greed, absolutely.
Gary, I mean, how do you explain this? I mean, the economy hasn't changed by 12% since the weekend, has it, in Japan? So, Gary, how do you explain this?
Well, I think it is pretty much a perfect storm of different factors acting together. And of course, things happening in the US and Bank of Japan decided to hike rate at a time that probably there are greater stress around the world. And I do think the market is overreacting by a very large margin. But still, when we look at the potential exposure to this sort of carry trade and taking the Bank of International Settlement as an example of the yen cross-border lending, it can actually go up to $1.6 trillion. And of course, not every dollar here is for speculation. I mean, some of them may be for real corporate usage, but basically there's a very big market size for this sort of carry trade. And beyond that, I simply think that the current positive cycle in equity has simply lasted for too long compared to the historical period. We are talking about a big surge since probably January 2023, and it lasts for almost 18 months. So it makes sense to have some correction. The correction seems to be overplayed. I think this is why after 2 days of a massive fear in the market, then people start to feel a bit more rational on whether this 25 basis point hike is really that detrimental to the asset prices. So yes, it's pretty much quite hard to explain, but it is a problem that actually exists in quite a basically huge market involved with international capital.
I mean, it doesn't look like the markets are going to get any more rational today. If you look at what futures markets are pointing to in Japan, they're pointing to now another big decline again today. Enzio, was the Bank of Japan wrong to raise interest rates then? A lot of people are pointing the finger at the Bank of Japan saying, look, you raised rates when the economy is still not strong enough to deal with it. You've said you're going to carry on raising rates. You've really spooked the markets here.
The central banks seem to have become the whipping boys. I mean, you know as well as I do that the Fed is being hit by the same bunch of stuff, that they're doing everything wrong. These are the Monday morning quarterbackers. I don't think that I wouldn't really be so presumptuous, not speaking the language, not living there, to really know. I just think that the 25 basis point change is really that the market then carry trades are unwound. People blame the Bank of Japan. The market overreacts. The Nikkei crashes. I think that's just all a bunch of lemming-like paroxysms. I just think it's so I don't see any rationality in that at all. And people just wanting to be fear of missing out, the FOMO.
I suspect, though, the problem is the hedge funds when you are facing massive losses. Because it's not the 15 basis point rise in interest rates that have done it. It's the 10% move in the yen that has killed these trades, isn't it? I mean, you can cope with your cost of carry going up by 25 basis points. It's much harder when the currency moves 10% against you. And then on top of that, the things that you've gone and invested in, whether they be US technology stocks, the Mexican peso, Bitcoin, whatever you've used your borrowings to invest in, are also now declining. So suddenly, as a hedge fund, you face massive losses. I suppose you've got no choice but to go and either hedge it or unwind it.
Yeah, but I guess my point just very quickly is that why suddenly now? I mean, the yen has been strengthening for the past 3 weeks. So why? What I can't understand is why suddenly now, when all of these things have been going on anyway. That's my key question. What was the trigger? And mine can only be that some big major bank probably said, "Hey guys, let's make some money now, and it's gone too well, and let's put on big positions in the U.S. and then off we go."
Or take off the big positions that they've already got on.
Yeah, exactly. Yeah.
Gary, from an economic perspective, was the Bank of Japan? Is it right to raise rates and to carry on raising rates?
Well, I would say the Bank of Japan probably see this as a golden opportunity to hike rate, and at the same time probably can amplify the policy impact because the Fed may be actually cutting rates soon. Because one of the biggest problems that they face is always this very weak yen that can affect the import price, and then it brings the inflation that it doesn't really want to have it that way, and that could have an impact on the domestic economy, etc. And well, maybe the Bank of Japan is getting what it wants right now, given the very big yen movement. But of course, I do think the key factor here is about this real wage growth. And of course, there's some positive development recently in the latest real wage data. But I think it's still important to see whether this is sustainable. And because I think the key factor here is that a large part of the Japanese saving. Japanese household asset is actually in deposit and saving. So in the past year, the inflation expectation has basically reduced their consumption incentive, etc. They just want to save. They don't have interest, etc. Then, well, it's really about whether this real wage expectation is because of the stronger demand, and then it can actually fit into the price and growth in the corporate, fit into the consumption sector, and then basically reignite this positive inflation cycle. So for now, I do think it's still a bet on the Japanese economy getting better. It is getting better, but whether it is actually that even, maybe a bit better in the large corporate, the small corporate may still be suffering. That is also true. So yeah, I think the Bank of Japan probably still heading towards the right direction. It's simply the current like a juncture, like the moment may be surprising to some.
Enzio, this rise in real wages is a positive sign, isn't it? But as Gary says, we need more data. I mean, this is just 1 month, and it's the first time in 27 months it's happened. But nevertheless, the Bank of Japan says it wants this virtuous cycle of rising prices and rising wages. So at last, maybe there is a sign there that they're getting it?
Well, I think that's the only justification for the rate hike, that they don't want this imported inflation getting really whacking the wage hikes. And so, as you said, the wage hikes have been real, not nominal. And maybe they want to. I'm sure that they want to stay on that route.
But I suppose the Bank of Japan's got to be careful what it wishes for as well here. I mean, although it's pleased, as Gary was saying, with the strong yen, if it gets too strong, that's going to make it harder, isn't it, for the BOJ to keep inflation at 2%?
Well, certainly not from the imported inflation side, as we all know, because that will fall quite precipitously. So I don't think that they're on such a. My view is that they're not on such a tightrope as I think you feel, because the imported inflation just abates that threat, as we all know, with the rising yen.
What about the Fed? That's the other side of this story, isn't it? Suddenly there's fears that after the Fed left interest rates on hold, that it's just pushed its luck too far. It should really be cutting already. It's now waiting until September, which is, a month and a half away yet. And in the meantime, fears that the economy is deteriorating quite rapidly. What do you think about that notion?
I think that the role of the Fed funds is way, way, way overdone. I looked at the numbers a little bit. The U.S. mortgage debt, which really has on the fixed side, which is the bulk of mortgages, is way bigger than the credit card debt or other consumer loans. The credit card debt and the consumer loans, we all know, are based off their prime lending rates. So I actually think that this Fed funds thing is also just a little bit of a casino, frankly, that I'm beginning to wonder just what the actual, you come out of the bond world, Peter. I don't really see how Fed funds actually affect bond yields, which in turn affect mortgage rates a lot of these long-term fixed mortgages, which is what the bulk of America's mortgage rates are about.
Gary, what are your thoughts on that? The US economy is not in bad shape, is it? It hasn't just suddenly deteriorated over the last week or so. We've seen, slowing jobs growth. We've known about that for a while. We know the economy is slowing, but it's not slipping into recession, is it?
Well, yeah, I agree with that. And I think the worries in recession is simply a bit overstated. And of course, one of the reasons that I think is a bit hard for the Fed to move in a very big magnitude, as in the market may be pricing 100 basis points this year. It's really about this still sticky inflation, and with geopolitical tensions everywhere, then it's quite difficult to see food and energy prices basically going down. And if you look at the shipping cost from Shanghai to Los Angeles, it has already been 7 times higher since the low level because of the Red Sea crisis that ships need to reroute. Then, for other basically indicators like rent and services, how fast can it actually go down? So if inflation won't really go down that quickly, then if there may be some disruption in labor market, but they may not be, that big because there has been some seasonality effect of the hurricane, etc., then maybe the overall economy is basically not too bad because the market seems to be very worried about the manufacturing sector in the U.S. But let's not forget, services is actually 70 to 80% of the total economy contribution. And if you look at whether households are actually facing greater stress, you cannot only look at credit card. And because even though the delinquency ratio may have increased to relatively high level, but that was also like a replacement effect towards some of the write-off loan of the student debt. So the overall pressure, including mortgage, as we have just talked about, basically consumers are not facing the same stress compared to the pre-COVID level. So I do think the pressure on U.S. households are basically overstated.
Enzio, what should the Fed do now? There are some people calling for the Fed to have an emergency rate cut right now of 0.5%. What do you say to that? I would have thought that if the Fed did that, that would actually spook the market even more, wouldn't it? Because they don't normally do out of cycle rate cuts, and it's not their job to protect the markets anyway, unless it's really affecting the stability of the financial system or the economy.
I think your national banner, keep calm and carry on, is pretty applicable here, Peter. I fully agree with you that if they did an emergency meeting, they would not only spook the markets, but they would also make them very unsure of the Fed's abilities. Now, the Fed's already, as we know, from many Monday morning quarterbackers, under a lot of fire because, if I'd been them, I would have done that and that and that. So there's a lot of crass stuff going on. And then, of course, you've got that genius economist, Donald Trump, telling the world what he would do, which is he'd probably just would love to nuke the Fed, frankly, and just get rid of it, and he can do the interest rates. So I think it's best that they just do what they think would. And my own view, you ask my view, I give you my view, which is, yes, I think they should, just to placate these lemming-like market sort of algorithms, is just get on with the rate cuts as of September.
And should that rate cut in September be 50 basis points now, as some high-profile economists are saying?
I think that would maybe then just put an end to this, put a stop to the rot, yes.
Okay. Gary, what do you think? First of all, on an emergency rate cut, what do you think about that?
Well, I think September seems to be a good time because if we ignore all this market turbulence, then we indeed see a deterioration in the U.S. economy, a slow one, not a massive decline. So I think it is the right timing to start the rate cut cycle. However, whether it will be as big as 50 bips, I have some doubt. It's simply because, of course, in the short run, we would look at the labor market, inflation, growth, etc. But let's not forget the election will be on in November, and if there are actually changing policies in maybe more tariff or tax cut, which will lead to a wider fiscal deficit, all of these policies will be quite different from what we see right now and can lead to high inflation and the pressure on the rate, so which will make the job of the Fed a bit more difficult. So with that uncertainty in mind, I just feel the Fed may not be able to commit itself to such a big rate cut, simply because no one really knows what will happen next year. And if inflation got out of control again, this can be really another blow to the credibility.
And presumably anyway, I mean, people are reacting to just one set of data, aren't they? Friday's non-payrolls data, which even, although it disappointed maybe forecasts, still pretty robust growth, over 100,000 jobs created. Presumably the Fed is not going to react to just one data point.
Yeah, I agree with that. And especially even in the press conference, of course, they was mainly referring to the inflation, saying that they won't look at one single data point, but more like a longer term trend. It won't basically affect their mandate. And I think the same is true for employment. Of course, there has been some problems about, after COVID, because fewer people respond to the survey, then there was keep on revision to the data point that actually it may looks a bit worse than it looks on the surface, because every time the number is revised down. But still, if we look at the trend, I would say is still rather robust in many ways. There's some pressure, but the pressure is not as big as it looks on the surface.
Okay, let's turn our attention to China. Enzio, we had some economic data as well this week on the services sector. The Caixin Purchases Managing Index rose to 52.1 in July from June's 8-month low of 51.2. That was above market forecasts. It's also the 19th month of growth in services activity. Was helped by a faster rise in new orders and also export sales. Business sentiment still subdued. So what do you make from that? First of all, it's good news, isn't it?
I think it's all that glitters is not gold. I really don't think that these numbers really are going to decrease the actual unemployment situation in China of the unemployed people. It seems as if the leadership across the board is quite anti-private sector. What they say and what they do is very different. I know they've been yelling a lot recently that they've got to get private consumption going, a little bit like trying to help an alcoholic by giving him aspirin by saying, well, let's just inflate the money. Many people are saying, let's inflate the money supply and get some more roads and bridges built. I just don't think that's the solution, because the private sector actually creates 80% of all jobs. And if they're thwarted, well, then how can you create jobs? So I just take these service sector numbers with a big grain of salt in terms of what they actually mean for the Mont Pa Kettle up in Guishan province or Jilin for their jobs.
Gary, what do you read into this Caixin data?
Well, I think sentiment would always be volatile, and indeed, if you look at the services sector in China, it's probably doing a little bit better than manufacturing, but definitely there's still a lot of pressure. And beyond the PMI, I mean, usually the data I really like to look at is the credit situation in China, and it's very clear that new loan growth has been growing, or basically decelerating for many months, and there's not really any signs of pickup. Actually, we do see a greater deceleration. And if you look at where people put their money, they all put it in the time deposit. So basically the private sector or for consumers, they're all under a certain deleveraging mode. So under that scenario, is how do you get people to spend out of their own pocket? I think that's the biggest question. So I think China has focused too much on supply in the past few years, and the demand side policy is simply not picking up.
And what do you make then of Beijing's announcement over the weekend to stimulate consumer spending? The State Council came up with these 20 measures to expand consumption in sectors like catering, home services, elderly care, and so on, and also try and get new types of spending like electronic sports, live streaming, e-commerce, and so on. What do you make of that?
Well, I think interestingly, we do see a few sectors that has been undergoing some regulatory changes or crackdown, like gaming or education services there. So I think the government probably realized that, okay, maybe it has gone too tough on that, but it's of course not easy to repair. And I think one of the problems that I think these measures alone will not be too effective is that China's disposable income growth has been decelerating. It's still slower than pre-COVID level. And when you look at the wealth effect, which was actually the case in the US to push consumer to keep spending, there's no wealth effect in China nowadays. If you look at real estate, if you look at equities, if you want to invest in bond, then there are restrictions on saying that bond yields cannot fall too quickly. So I think there is a problem about how households actually think whether they will get more well off in the future. And then, of course, that will have an impact on how much they consume. So, yes, there can be some guideline, there can be some subsidies in terms of, encouraging people to spend. But I think this alone will not change the full picture.
Enzio, you've been saying for a while, China needs measures to boost domestic consumption, consumer spending. Is this it? Is this going to do it?
I don't think so. Again, I don't speak the language. I don't live there, but this is my Monday morning quarterbacking. I just don't think since January, with the party state capitalism having become very, very pronounced, and that's their choice. I mean, that's how they want to go, and they're a pretty impressive economy, I got to say. It's just, I guess, because I was trained by von Hayek that I'm just more of a market guy. So I think this is wishful thinking. I think it's a little bit like in anywhere in the world that if one person says it a little bit like the markets, well, then everybody sort of brandishes it like Hong Kong has not gone Hong Kong, it's now Hub Kong. Everybody uses the word, third word is hub now. I see a lot of bark but no bite.
Okay. Finally, Gary, can I ask you about Australia? The Reserve Bank of Australia met this week. They left interest rates on hold for 4.35% for the sixth straight meeting. I suppose, Gary, Australia is the one major central bank where there are still fears that they could actually raise rates, that they're not confident yet that they got inflation under control. Do you think that's likely?
Well, of course, if you look at the external situation after the Bank of Japan, drama, I don't think any central banks will want to hike rate at least in this month. But if you look at the domestic situation, indeed, there's still quite a bit of pressure of inflation staying way above the policy rate target. There may be some deterioration to employment, but the overall situation in the Australian economy seems to be still holding up quite well. And under this relatively probably less hawkish Fed than if the RBA actually hike right now, that can also have an impact on the import inflation because the Aussie will actually get weaker. So I think it's probably one of the major banks that will find it quite hard to actually cut rate this year. I think it will be quite difficult. The earliest time will probably be around Christmas, but I wouldn't be surprised that RBA will only act next year.
It's going to take a brave central bank, isn't it, to raise rates at the moment, particularly if the Fed starts cutting by 50 basis points.
Yes, indeed. And also beyond Australia, another central bank in the region, beyond Japan, is Taiwan also sees a bit of inflation pressure as well because of all this booming AI tech and export. So it's not a big central bank, but still I think some other central banks in the region also share the same concept.
Enzio, I don't know if you follow Australia or not, but these Antipodean central banks, Australia, New Zealand, have been sort of a little bit the canary in the coal mine, haven't they? They started raising rates far earlier than everyone else when they recognised, and maybe some other notable central banks didn't, that inflation was becoming sort of entrenched, and they moved pretty quickly to raise rates and to try and sort of squash that. So are they still ahead of the curve?
Peter, I'll be upfront. I don't follow these two economies, so I really don't want to sort of just make something up. I just don't know.
Oh, okay. Gary, let me ask you finally then. I mean, these two central banks down under, Australia, New Zealand, they have been sort of ahead of the curve, haven't they? Certainly when it comes to raising rates anyway. They sort of moved far quicker than other central banks around the world. So are they still ahead of the curve?
Well, I would say even though they may have moved earlier, then of course the inflation hasn't been that out of control compared to some of the other economy. But it doesn't mean that inflation will not stay elevated because of different reasons. And I think Australia and New Zealand are probably smaller economy than many of the others, so they will be more affected by external situation, for example, demand from China or basically other types of import of Australia, also the commodity prices as well. So for now, probably it's hard to say that they would be able to stay ahead of the curve, and basically the recipe that it gives to the economy to tame inflation probably is a bit tamer. It will last a bit longer, but the immediate impact may not be as big as those maybe in the EU and also US. So I think this is why it's likely that we may see rate staying elevated a bit longer than some of the other economies.
Okay, well, thank you both very much for your thoughts this morning. You heard there Gary Ung, who is Senior Economist for Asia-Pacific Thematic Research at Natixis, and our regular Wednesday commentator, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. I'm joined now by John Beirne, who is Principal Economist at the Asian Development Bank. Morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. Watching with interest the drama in Japan, a 12% slump in the Nikkei 225, a 10% rally yesterday, and this morning back down again. Nikkei 225 off close to 3% at the open. This is, I know markets are not particularly rational, but nevertheless, major developed markets like Japan are not supposed to move like this, are they? What's behind it?
Yes, a lot of action recently in Japan. I think this was all, of course, driven by the appreciation that we've seen taking place in the yen following the Bank of Japan's increase in the interest rate. Now, there were some market participants expressing some surprise at the increase in the interest rate. But I think on top of that were the more hawkish tones by the governor, which perhaps accentuated the developments that we've seen taking place in the previous few days, which of course, as you said, reverted as markets have perhaps realized that there was an overreaction to these developments that took place.
There was a reaction, then an overreaction, and now an overreaction of the overreaction. It's getting a little bit confusing. But several people, as you mentioned, pointing the finger at the Bank of Japan here, saying this is their fault. They've moved too quickly. The data didn't support a rate rise. What do you say to that?
Well, I think, if one looks at the data, it's clear that inflation is remaining above target. Now, the issue for Japan, going back many months, is the nature of this inflation. So is it the type of inflation which would warrant a monetary policy response? So is it demand-driven inflation or is it supply-driven inflation? And by all accounts, it seems that a large proportion of the inflation appears to be supply-driven. But I think there are underlying concerns about the level of the yen and the extent to which that could affect the inflation outlook. And there are also concerns about, the restrictiveness of the monetary policy stance and moving towards a more normal level of interest rates. On top of that, we also must bear in mind what's happening in the US, which is also having a big factor on what's happening. Also in recent days, we had mixed signals in terms of the jobs numbers that come out of the US, which were, pointing towards people talking about 50 basis point cuts. More recently, we saw the service sector jobs going the other direction. So again, I think developments outside of Japan need also to be taken into account.
But there is pressure now on both sides of the carry trade, isn't there? Japanese rates are going up, US rates are going to come down eventually, and that's sort of squeezing, if you like, the profitability of that carry, although it's still pretty large, the differential, isn't it? When you've got interest rates at 25 basis points in Japan and 5.25% in the US, that's still a pretty large differential. But I suppose what's killing this trade is the move in the yen, 10% in, just a couple of weeks. That presumably is partly what's making the big difference to these carry trades and causing people to unwind them.
That's right. We are seeing, whilst there is some appreciation that has taken place in the yen, which of course reverted then in the more recent period, as you said, the yen is still at a relatively weak level. We will still see an interest rate spread between the US and Japan, regardless of whether there is, some easing by the Fed and in conjunction with some increase in rates by the Bank of Japan. There still would be a significant spread, which would make the carry trade still a viable strategy. So I think it's certainly not over yet, but I think some surprise in the market, as I said, was perhaps related to the statements that were coming out by the Bank of Japan following the interest rate rise, in that it would be open to more rises going forward should the inflation outlook be affected.
That's where some people are criticising the Bank of Japan, isn't it? They said, okay, they've raised rates, but it was a very hawkish message that went with it, whereas the markets would have preferred maybe a more dovish message, but that's not what Governor Ueda delivered there. It was a rate hike and a hawkish message afterwards.
That's right, and it may point towards some stability going forward as regards monetary policy. I think that if we look at the more recent indicators, for example, real wages have turned positive for the first time in around 2 years. But on the other hand, household spending has declined. So I think there are still this concerns around consumer sentiment and the extent to which these real wage rises would be sustainable, whether they would pass through to consumption, whether they would trigger domestic demand. And if that would all take place, of course, we would have a strong case for further monetary policy normalization in Japan.
I presume we need more data, don't we? Because this was just 1 month of data. It's the first time, as you're saying, 27 months that real wages have been positive. So I suppose it's the very, very first signs of this virtuous circle of rising prices and rising wages that the Bank of Japan want to see. But I presume they need to see several more months of this.
Absolutely, yes. This is just one data point. There would need to be much more evidence that the real wage growth would be in positive territory in a more sustainable way. And, there would also be a lag through which consumption would be affected by these real wage rises. And as I said, household spending is still, it declined in the most recent data point. And it will certainly take some time to restore sentiment that would trigger consumption, that would trigger domestic demand, both on the consumption and the investment side. So I think, as you said, we will need to see more evidence in regards to data going forward.
Let me ask you about the Japanese market itself. I mean, when investors do these carry trades, they're borrowing in yen, converting it to the US dollars, investing in other assets. What they are doing, though, is they're not investing in Japanese assets, are they? They're investing in things like Bitcoin and US tech stocks and the Mexican peso. So in the meantime, presumably, there's not so much reason for all this pressure on Japanese shares. They're still looking pretty cheap, and even if people unwind the carry trade even more, they're not going to sell Japanese shares.
That's right. We saw a rebound in the stock market in the more recent period, and this is precisely related to what you're talking about. So, despite the recent moves that we've seen, the yen is still at a relatively weak level. So there will be appetite for getting into that market, as well as that. There's an underlying corporate governance reform taking place, which is outside of the yen, which is also affecting share prices, which has not been affected by the recent developments, of course. But, even though the yen has undergone some significant volatility in the recent weeks, I think that it's still at a very relatively weak level. So it's still attractive to come into shares at the moment.
And those reforms that you mentioned, are they still on track? I presume this doesn't derail that initiative for Japanese companies to try and shed, non-yielding assets and to try and to try and return capital to shareholders. That's all still on track.
Yes, that's still on track. Of course, it's an ongoing process. It will not happen overnight, and it has been in place for quite some time now. But there is a strong degree of effort at increasing value and ensuring that the corporate reforms that were announced are actually implemented going forward.
And over on the other side of this, the US economy fears that the US economy is deteriorating rapidly. Do you think they're overblown? The data doesn't really show that at the moment, does it? Although the jobs market is clearly slowing, we're not at recessionary levels yet, are we?
Yeah, well, I think there was an overreaction to data. There's perhaps a over-focus on this data dependence to some degree. I think what we saw in the recent days was a combination of two different factors: what happened in Japan and what happened in the US as regards data releases. As I said, the jobs numbers that came out of the US, put forward a very negative picture, and created this fear of a recession. But a few days later, service sector PMIs, service sector numbers came out to show that actually it's not so bad as it seems.
And there have been calls from some quite high-profile economists for an emergency meeting of the Fed and to implement straight away a 50 basis point rate cut. Now, you've worked at central banks. I presume this is not how central banks operate, is it? They don't normally do out-of-cycle rate hikes or rate cuts. Unless there's a real financial crisis going on or something that's really affecting the economy, which isn't happening at the moment, is it? So I presume the Fed is not going to entertain that idea.
Yeah, I think this would be unlikely. I think, this would also, put forward a significant signal that we are actually in a serious recessionary problem, and I think that this is not likely at the current juncture.
And that would spook the markets maybe even more.
Yes, it could actually be self-fulfilling. It could actually trigger some further negative sentiment and trigger a more severe sort of a downturn, which would be perhaps unwarranted based on the data.
And what about the other thing that's been called for is the regular meeting of the Fed in September is to go and cut rates by 50 basis points. What do you think about that?
Yes, well, as we alluded to, I think there is some degree of overreaction, I think, by the markets based on the data that was coming out of the US. There were concerns that the labour market was signalling significant deterioration in the economy, significant weakness in the economy going forward, and that triggered this talk that a 50 basis point cut may be necessary. But if we look at the data as a whole, I think the argument is quite reasonable that a 25 basis point cut would be in line with expectations based on the data.
What about finally the geopolitics? Should we be concerned about that? That's been another reason cited for this sell-off. We've got potential wars in the Middle East. We've got tariffs being imposed on Chinese goods. We've got the potential of a Donald Trump presidency and even more upheaval in the trade sector. Is this something that we should be monitoring and could be partly causing the downturn?
Well, I think it's definitely something that we should be monitoring in terms of risks to the outlook. Geopolitical risks and tensions are always somewhat simmering, and certainly they could kick off should developments worsen in the Middle East, and this could affect oil prices, for example, which would affect the inflation outlook, would affect the global outlook in terms of growth. As regards the tariffs, this is also another factor which needs to be taken into account when we're considering the risks to the economic outlook. But the more recent period was really driven by developments with monetary policy in Japan, combined with the outlook and some of the data that was coming out of the US.
John, always a pleasure talking with you. Thank you very much indeed.
Thank you.
That's John Beirne, who is Principal Economist at the Asian Development Bank.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening this morning and for supporting independent, fair and balanced broadcasting in Hong Kong. Please help by subscribing to my daily Asian newsletter. It's completely free of charge, and that's where you'll find more information on some of the topics we've been talking about today. You'll find it at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and Louisa Fogg, who's China equity strategist at Bank of Singapore, and with a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting over in Taipei. See you tomorrow.
Money Talk.